Welcome, guys. Welcome, guys. Welcome, guys. Welcome to Maximus CPA, brought to you by SO Speaks CPAP LLC. I'm O'Neill Speaks, CPA, based out of Charlotte, North Carolina. Very excited about this one, guys. But first, want to just tell you about what the general idea and plan for the channel will be. So, the Maximus CPA will focus on personal finance and investing and saving for retirement, budgeting. So it'll take a more holistic side of personal finances. Guys, I hope you subscribe to the channel, comment on videos. Let's interact and learn as much as possible. All right, so for this series, we'll be focusing on this series is called the Tax Savvy Real Estate Investor, and we'll focus on all things real estate, right? So the tax code is super convoluted, is voluminous, is complicated, but once you realize that the tax code its purpose is to do more than just raise revenue for the government, and that you see that the in planning the tax code, the government really put in like loopholes and benefits to incentivize behavior, and that's not more evident than any other field other than real estate, right? So the real estate uh tax code uh is full of subtle nuances that if you really tap in and know, learn about it, it can be very beneficial for real estate investors. And so we'll in this series we'll follow some of those subtle nuances and learn as much as we can about it. um in this particular video, we're going to learn about 1031 exchanges. You guys might be familiar with the terminology and like the overall benefit of it, but in this video, we'll do a kind of a deeper dive into it. So yeah, we're going to be learning about 1031 exchanges on this video, and then the next video we're going to get more into appreciation and accelerated depreciation. I kind of flipped the two videos because I've gotten a lot of requests for 1031 exchanges. A lot of clients want to learn about 1031 exchanges, so kind of flip those videos so I can get that content out beforehand. So yeah, 1031 exchanges, right? So if you've been in the real estate game for a while and read a couple books, this is probably one of the most beneficial, definitely top two most beneficial loopholes or benefits provided by the tax code. And in this video, we're gonna dive into the weeds a little bit. First, we're gonna learn about the benefits of 1031 exchange. Then we're going to learn about the time limits and other requirements, and then we're going to touch a little bit on the requirements to use a 1031 intermediary, because it's not a benefit. You have to do it, or it'll fall apart, and all your gains will be taxable. And I'll name out a couple 1031 intermediaries that I've recommended for clients that are great. And you definitely want to use a more reputable 1031 intermediary. All right, so the benefits. So I like using storytelling through my videos. I think it kind of drives the point home a little bit better. So let's meet Jamal. Jamal is a real estate investor. He has several properties that he currently manage and own. And he's thinking about, okay, so he has a property that's not producing much cash flow. It's appreciated in value quite a bit, but the cash flow is not quite where he wants it to be. So he's thinking about selling it and buying another property. And because the property has appreciated in value quite a bit, he know that he'll be hit with a big gain, and he'll have to pay taxes at the capital gains rate. So he talks to his CPA. He goes and say, okay, I plan on selling this property. I'm probably going to be hit with a $1,000 gain. Is there anything that I can do? And his CPA tells him about 1031 exchanges. And whenever you sell business or investment property, and it has to be business or investment property, and you have a gain, you generally have to pay tax on that gain, right? But IRC Section 1031 provides an exception and allows you to postpone paying tax on the gain if you reinvest the proceeds in similar or like kind property as part of a qualifying like kind exchange, right? So the operative words here that I want you to get is postponed. Know a lot of people on the internet saying you're you're just ignoring the gain. You're like you'll never have to pay gains on that taxes on that gain, but that's not true. It's kind of like pushing it down the road a bit until you sell that final property. But it's very beneficial. It can save thousands of dollars in taxes in a given year. But the property that you exchange has to be for business purposes or for investment purposes, so it can't be personal use assets, right? So the exchange can include like kind property exclusively, or it can include like kind property along with cash, liabilities, and properties that are not like kind. But if you receive cash or relief of debts, you will have to pay uh, a capital gains tax on that specific amount. But if you do exclusive property exchange, you won't owe that capital gains tax does uh if it's proactively planned and with a 1031 intermediary, which we'll get into later. So what are the some qualifying properties? So both the relinquished or the sold property and the replacement property you buy must meet certain requirements. Both properties must be held for use in business or reinvestment or for investment. So like I said, no personal use assets. And for example, you can use for single family rentals, duplex, triplex, or fourplex, apartment buildings, hotels, office buildings, etc. And my man Jamal here, he sees that okay, my property fits that. He's a single family rental real estate investor, so his property fits. So he decided he can make some moves with his property because it qualifies. And so, but what assets or properties are ineligible for 1031? So primary residences not used for rental. Second, vacation homes not used as rentals. Personal properties, things such as furniture, fixtures, equipments, etc. And this one gets a lot of real estate investors. Fix and flop properties. For the tax code, fix and flop properties are considered inventory, and you can't do 1031 exchanges on those, not unless they're you convert those into rental estate. Or the last ineligible uh asset is a partnership or LLC interest, and you'll see that come back into play later. The next requirement, which is you know, can be very scary or anxiety inducing is the timing requirements. While a like kind exchange does not have to be a simultaneous swap of properties, right? So you don't have to have the property that you're replacing the one you just sold with immediately. There are requirements in terms of time, and these limits cannot be extended for any circumstance or hardship unless there's a presidentially declared disaster, right? So the first requirement is the 45-day deadline to identify placement property. So you have 45 days from the day that you sold your property to have a list of properties that you are interested in acquiring. And that has to be in writing, and it has to be submitted to your 1031 intermediary, right? So it has to be in writing, has to be submitted to your intermediary, and you at least have to have one property identified. But It's best practice and common practice to have more than one property identified just in case some falls through. But if you have more than three properties, there's just two th 2,000%. Sorry, I know that says 3,200%, but it's 200% rule. So if you have more than three properties, the three properties in total can't be more than 200% of the price that was sold that you sold for your last property. So it's the 200% rule, guys. And I have that fixed. It's 200% rule. Um, so you have 45 days from the day of sale to give your intermediaries a list of properties that you want to do a 1031 exchange on. And in that writing, in that listing that you give your intermediaries, you have to be as detailed as possible, right? So you can't just say a single family home uh, in Charlotte, right? So you got to be give the address description, city, zip code. So you got to be as specific as possible, and so it can be uh, identify easily as being a qualifying property. So after the 45-day rule deadline, there's a 100-day purchase deadline, which means that you have 180 days from the sale of your property to close on your replacement property to meet these deadlines, right? So um, there's no getting around this rule. And the 180 days are calendar days, not weekday days, but it's calendar days and holidays count. So you don't want to get to Christmas around Christmas time and these people take off work um at the 1031 intermediaries to report that you successfully bought a property, but it's Christmas Day and everyone's closed, that still counts. So you don't want to really kind of get into that stickiness. And uh but you also don't want to allow that deadline, right, to really cause you much stress, right? So these timing requirements can be stressful. So what if it's like day 175, you're trying to close on the property, but stuff keeps falling through, and then bam, 180 days is here, and now you owe tax on all that gain because you didn't meet the deadlines. So sometimes getting into a bad deal also can happen, right? So if we are close to uh that 180 deadline and we found a property, but we're in a bidding war with someone else, and through our analysis we say, okay, $500,000 is good amount for this property, but since we know that 180-day deadline is coming, we bid 550, and now that property that was once good property analysis wise is now a loser, right? So I think proper planning is required for these 1031 exchanges in order for them to be uh, for you to get the best outcome. So the best workaround that I try to tell my clients is something called a reverse 1031 exchange. And a reverse 1031 exchange is you pretty much go find and close on the replacement property first, right? So the government doesn't care what order that this happens in, but if you can go find the replacement property first and close on it, then these timing deadlines aren't as scary as they would be otherwise, right? So I normally try to recommend, if we can do a reverse 1031 exchange, let's try it. But if not, it just requires proper planning. This is a requirement that not many people actually know about, right? So, in the books that real estate investors read, you normally hear about the qualifying properties and the timing requirements, but there's also a monetary requirements, and I think this one trips people up more than anything else. So, in order to defer all the gains for the tax purposes from a 1031 exchange, there are two essential monetary target amounts you must meet. And that first one is the purchase price target for replacement property. And this one says that the total net purchase price of replacement properties must equal or exceed the net sales price of your relinquished properties, right? So let's get back to my man Jamal, right? So this example down here below is an example for the equity target replacement property, but we can use it for the purchase price target for replacement rule number one. So my man Jamal sold the property for 500,000, right? Um, and he had $35,000 in selling costs. So we can subtract that and say that the replacement property that he buys has to cost $500,000 minus the selling cost, so 465. So his replacement properties has to the purchase price for his replacement property has to cost at least 465, right? So taking into account selling costs, it has to meet that $465,000 threshold. Um, and that's kind of a easier one for investors to understand, but the equity target for replacement property uh, target is a little bit more of a sort of nuance that real estate investors have a bigger time understanding. So the equity target for replacement property, that rule says the net equity you fund into your replacement property must equal or exceed the net equity you receive from the sold property. What? Right? So this is why I provided a an example for this one to make it kind of more understandable. This is my man, like I said, Jamal, bought a property for 500,000, had $35,000 in selling costs, and he had to pay off a loan of 200,000. So he had $265,000 in net equity target. So whatever his replacement is, he'll have to at least have $265,000 in net equity. But so Jamal goes and find a property. The purchase price is 495,000. Yes, $25,000 in purchase costs, and he had a new loan balance of 225,000. As you can see, he's short of the target, so he should have worked up a deal that had at least 265,000, but he only had 225,000. So what's the consequence? So Jamal will actually have to, he's actually short, and that 40K difference comes taxable. So instead of him having to pay uh tax on that whole gain of 300, now he only has to pay tax on that 40K. So it's he still owes tax, but it's definitely better than not doing the 1031 exchange. So that's the net equity target for replacement. So keep in mind, that's why I'm glad we can do kind of a deeper dive, because like I said, investors really don't know about this requirement, but just keep in mind the purchase price target for replacement property and the equity target for replacement property. This is another one that is kind of more understandable, and investors know about the ownership title slash title requirement. So another requirement of 1031 exchanges is that whoever sells the relinquished property has to be the same person that takes ownership of the new replacement property. Where this comes into play that I've seen is when a person wants to go in partnership with a couple people he may know. So he may uh sell his property, and the new property he'll try to put in the name of the partnership, but it can't work like that for 1031 exchanges. So whoever owns the property, the relinquished property, also has to be the owner of the replacement property. And the major question that I get is, what about spouses? So husband and wife uh have a property. Do both owners need to be on it at the end for the replacement property. And that really depends on what state you live in, right? So you have community property states versus separate property states. So in community property states, uh, the couples are essentially identified as being one, right? So if you husband and wife owns the relinquished property, only one of them have to be on the ownership at the end, and that's normally comes in with financing and getting bank loans. So the bank might think that the wife's income requirements meets their standards more than having the husband on. So maybe the wife is just on the title for financing purposes. So you can do that in a community property state, but in separate property states, you wouldn't be allowed to do that. And what about LLCs? I've seen this happen quite a bit too, where um, again with bank financing, banks like lending out to people instead of lending out to LLCs. So what if a single member LLC, and it has to be single member? Let me reiterate that single member LLC uh, sales of property, and the replacement properties is in the name of the LLC owner. Is that allowed? And the answer is yes, because LLCs are treated as disregarded entities, so it's essentially still in the name of the LLC owner from start to finish. So that only applies to single member LLCs. When we get into multi-member LLCs, that's more of partnerships, and the 1031 exchange requirements wouldn't be met in that situation. So, which taxpayers are eligible for 1031 exchanges? So virtually any taxpayers. You got individuals can do this, single member LLCs, partnerships, S corps and C corps, trusts, etc. So it's really out there for everybody. And the biggie, right? So a lot of real estate investors, or really self-driven people who got it out the mud themselves, right? So they think they can do everything themselves. They can, fund a deal and XYZ all by themselves. But the 1031 exchange and intermediary requirement is essential. It's important to note that you need to hire an independent third party to act as your qualified 1031 accommodator or intermediary. And you must have this intermediary before you sell your relinquished property. Because in the 1031 exchange, one of the major rules is that you can't take hold of cash at escrow, right? So you just sell the property and you can't get the cash from the person that you bought it from. So you gotta, I mean, that you sold it to. You can't take hold of that cash in that transaction, but that cash has to go to the 1031 intermediary. They hold custody of it, and then that's how you qualify. So that's why you have to have the intermediary before you will relinquish that property, because you can't hold the cash in that exchange. And I like to tell my clients to make sure the intermediary that you work with is uh very experienced. They know this transaction in and out, and that is reputable, great reviews, and they're financially sound, right? So, because a lot of these intermediaries have went bankrupt in middle of transactions and caused a lot of headache for investors. And I like to recommend these reputable 1031 companies. It's IPX 1031, Asset Preservation Inc., and Exitor 1031 Exchange Services LLC. Just a couple that I like to throw out there that I work with that are pretty good. And so my boy Jamal has his 1031 intermediary before he sold, so that $300,000 gain is still able to be deferred. So Jamal is all set. But so what can go wrong, right? And it's, as you can see, after learning all these requirements, a lot of things can go wrong. And so now that we have a powerful 1031 exchange can be, it's important to discuss what can happen when the strategy is not implemented correctly. And so I normally like to share the story from a client. I won't use her name, but she had this property, uh, that was bringing in the property has appreciated a lot. The cash flow was great, but the management side of the property was becoming a headache for her, right? So she had great income, a W-2 income, but the managing of the properties was becoming a headache. So she wanted to, alleviate some of the headache, and she wanted to. She heard this deal. A friend told her of a deal. Uh, a syndication where this LLC was looking for um, money to come into the LLC, and so they were offering a percentage of ownership in the LLC, and the LLC was going to go buy a hotel and some apartments, and um, so she could go buy a membership into that. So she was excited before talking to anyone. She uh, sold her property and went to buy a percentage into this LLC membership, and she, you know, thought she could still qualify for the 1031 exchange, but her former CPA didn't advise her well and had to unfortunately come up and say, actually, you don't meet the requirements, but for several reasons. For the membership LLC, remember, we said that disqualifies you. The title requirement, she failed that, and she didn't use a 1031 intermediary. So for several reasons, she ended up having to pay gains on like $200,000 of 200 gains on $200,000. So if you don't follow like the subtle nuances of this, you'll definitely fall into a trap. So definitely get with your advisors, proactively plan, get with your intermediaries, proactively plan, and just make sure you do it right, because this is a uh kind of a costly undertaking. So you don't want to have to pay those costs and still have to pay taxes at the end of the day. And you definitely, or speaking of costs, you want to do a cost benefit analysis on, is this even worth going through? Is it worth paying, saving a couple $1,000s in taxes if this also costs a couple thousand? So, like I said, just proactively plan. I'm a big proponent of proactively planning and getting with your advisors, getting with your CPAs, who know your personal situation a little better. So what else can go wrong? Um, you turning in your 45-day identification list late. Big no, big problem. And like we discussed earlier, paying too much for a replacement property, because you have that anxiety of the clock running. So you want to make sure you get that property, but you end up paying too much for a property. And this next one kind of goes along with that, is buying a bad asset, because you feel the pressure, so you just go buy something. And as smart as you are as a real estate investor, it requires appropriate analysis, appropriate planning to get a good deal. And that's when it's not having that intermediary. We discussed that quite a bit. Receiving a check at the close of escrow is also a big no-no that disqualifies you at bat. But you can get money out of the deal. You'll just have to pay tax on whatever you take out of there. Not communicating with advisors, which pretty much can help you solve all these problems if you properly communicate with your advisors, or one who knows the real estate industry, know the game. They'll be able to help you. And partial reinvestment is another area we find. Uh, Investors are surprised that they didn't invest the whole gain into another property. Now they owe tax on some of that, right? So sometimes for some people that small amount of tax is fine, but you have to know before going in that if you don't fully reinvest those funds, a part of that will become taxable. All right, so and the last question that I received the most, And a lot of CPAs or advisors don't really can't give like a good answer on it. Is can I cash out uh without paying taxes on my 1031 exchange? Right. So we know in the 1031 exchange, um, by now they you have to keep the money within the deal for it to not be taxable. But is there a way to kind of get around that without being taxed? And can we circumvent the rule of not of that whole gain and cash not being taken out? And the answer is yes. But it depends, right? So CPAs love using it depends. With refinancing, uh you can actually take money out of the deal. So you sell the property, you find a replacement property, and that replacement property appreciates in value. Um, you can go to a bank and say, okay, I have equity in this house. So most 1031s it changes, you will have built-in equity, right? So you'll have equity in the house, um, or the house can further appreciate in value, and so you can go to the bank and say, okay, I have equity in this home. Uh, I would like to take something out through refinancing, and as long as that money is used for business purpose after the 1031 exchange, you'll be fine. But if you try to do a refinancing before the 1031 exchange, the IRS will think if it's done through tax law, if it's done anytime closer to 6 months in closing, um, you'll probably have to pay tax on it. But if it's done after the deal, after the 1031 exchange, and you refinance the property, you won't have to owe taxes on that. But get with your advisors and make sure that it fits your specific situation, right? So proactively plan. That's what I always like to get at. You have to proactively plan in these situations, or you can mess up something and you'll end up owing a large amount of taxes. But you can get your cash out through refinancing if it's done appropriately and it's used for business purposes. Whew. I felt like that was a sprint, right? In this marathon, but I hope you guys learned a lot. Thanks for watching. If you have any questions, hit me in the comments. Shoot me an email. Call me, and we can discuss your specific situations and circumstance, and see if a 1031 exchange could work for you. So the next video that will come out, we'll talk about depreciation, accelerated depreciation, and we'll go on from there. Uh, this is Maximus CPA, brought to you by SO Speaks CPA PLC. This is O'Neill Speaks. I hope you guys learn. Really hope you guys subscribe, lock in, and let's learn together. Thanks, guys.